Afternoon to you all, friends. I'm Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board. On behalf of my Vice Chairman, CA Vishal Bhai Doshi, we welcome you all to the 117th program of WSP for this council year. Today's topic is modification to the auditor's report, issuance of the emphasis of matter, qualified opinion, adverse opinion, or disclaimer of opinion. We have with us today as a moderator the chairperson of Patiala branch, CA Chinki Vermaji, and the guest speaker, CA Padmashri Presto. Friends, the Auditing and Assurance Standard Board has been organizing these programs on a very regular basis and has been undertaking many other initiatives. For example, recently we have come out with a checklist on auditing standard and the working paper templates. Please use them as may be required. And friends, also we have an expert helpline to answer your questions relating to auditing while doing the auditing. And this service is free of cost. Please avail these services and ensure that you deliver the best of the audit quality in the audits that you do. I'm really thankful to the moderator of the program, CA Jinki Vermaji, for jointly hosting this program, and also to the guest faculty, CA Padmashri Kasturi, for accepting our invitation to be the guest faculty. May I now invite the moderator of the program, CA Jinki Vermaji, to say a few words, and then also invite CA Padmashri Kasto to deliberate on the topic. Thank you, and over to you, Jinki.
Very good afternoon to all of you. A special thanks to CA Sanjeev Kumar Singhalji, Chairman to Auditing and Assurance Standards Board, and the Vice Chairman CA Vishal Doshiji, who is thou not live with us today. But I would be very, very thankful for giving me this opportunity to address this magnificent gathering. I welcome all the delegatories, fantabulous CA aspirants, and today's honorable and knowledgeable guest speaker, CA Padmashri Krastoji. Before getting started, I would like to take a moment to share appreciation for everyone timing up their schedules and joining us today. Without further ado, I would like to introduce our speaker today, CA Padmashri Krastoji. She is an accredited CA, holds Bachelor of Commerce from Mumbai University, Bachelor of Law. She did Diploma in System Audit. She is a partner with Audit and Assurance Practice at MSKC and Associates. She operates out of Mumbai office and has over 20 years of extensive experience in practicing audit service. She holds industry expertise, includes insurance, financial services, and manufacturing. She is responsible for quality assurance function in audit and assurance, and all the coordination and conduct of regulatory reviews. She is also part of global quality review team. She's in charge of keeping audit team well informed of latest technical developments, preparation of certain publications for internal as well as external use. She possesses in-depth knowledge of standards of auditing, both Indian and international, quality standards, methodologies, IFRS, company law, accounting standards, Ind AS, IPO related matters, other statutes, and knowledge of audit tools too. She imparts training programs of professional interest in audit tools at various forums. She's a contributor to WIRS and ICI publications, a special invitee to Center for Audit Quality and technical reviewer of financial statements. She is present and technical reviewer. Now, ladies and gentlemen, please help me in giving warm welcome and inviting her to start with today's session. Please, ma'am, share your words of wisdom with us. Thank you.
Thank you so much, Chinky. And thanks, Sanjeev sir. And thanks to Vishal sir also. And a very big thank you for all the people who are attending this session. And we know that this is a very busy season. We're in the midst of the busy season. This is an apt time to actually discuss the audit qualifications, modifications, how we draft them, and how we have to be, appropriately wording it as such, so that the user of the financial statements get to know that what is it that we are trying to convey through our audit report, and whenever we what is it that actually upholds the true and fair view. Without taking too much time, I would start off with the presentation. So Chinky ji, if you can confirm that you can see the PPT.
Yes, ma'am.
Yeah.
I can see.
Sure.
It's totally visible. Yeah.
Thank you. So what I have tried to do is, the flow of the audit report and a little bit of theory I have marked here. But I know that many of you are, all of you rather, are already experts in the standards, and not getting into too much theory would focus more onto the practical aspects and the do's and don'ts, kind of. How to draft, what are the typical things that you go through, what are the important things. So I've kind of pulled out some examples of qualification, EOM, material uncertainty, and things like that, and a very typical report of no going concern report, that is when financials are prepared on completely liquidity basis. These kind of things I've tried to collate amidst the theory. I have one or two questions in between just to keep everyone engaged as well. So with this short brief, this is what we are going to cover today, though the table of content looks larger. But we will more be discussing the things, and it more be interactive rather than be it being a monologue. You can always post your questions in the question answer section or in the chat box, I guess, or you can pause and ask the questions at the end. Either way, it's fine. We will take up the questions later. So what is it that we are looking into? These are the set of standards that deal with audit report, right? I'm talking about general purpose audit report. I'm not talking about special purpose audit report here. So 700 is how you present a report and what is the form and format of the report. 701 key audit matters. 705 when you qualify, modify, adverse opinion, disclaimer of opinion, what is the form and content. 706 emphasis of matter and other matter. 710 is what is it? It is talking about comparative information. 720 other information in the auditor's report. So set of standards under 700. This is the entire gamut of standards under 700. And since we are issuing general purpose financial statement, we have to be very careful, and we are issuing it. Just I'll take 1 minute before we proceed on to the general purpose financial statement. So as we all know, there are two types of opinion. One is general purpose opinion, and second is special purpose opinion. When is it not a general purpose opinion, and when is it a special purpose opinion? Let me take an example, that a company has 31st December year end, and it is preparing a set of financials for only for the purpose of tax audit. It is not going to be used anywhere else. It becomes special purpose financial statement. General purpose financial statement is every statutory audit which is required under Companies Act, which is widely submitted, circulated everywhere, and which is actually submitted to, say, bank, tenders, income tax department, GST, for all the purposes. So that is general purpose financial statement. What is the difference between general purpose and special purpose financial statement? Two big differences. One is you are preparing the general purpose under the given statute. So it can be an insurance act, bank act, it can be a companies act, something like that. And what is special purpose? It is required by only a set of regulation or only by a set of people. It can be for the management under a specific framework, or on the basis of opinion only for the purpose of consolidation abroad, something like that. That is a special set of purpose, special set of financial statements. Second important distinction, in general purpose financial statement, which is SA 700, you never put a restriction on use. that there is a restriction on use. This is only meant for these people and not meant for anyone else. If it is seen or relied by someone else, I am not responsible. Now, this kind of declaration or restriction on use comes only in case of special purpose report and not in general purpose report. In case of general purpose report, this restriction is not there. So it is actually easily relied upon, and it is a wider group relies upon the same. Always keep these two things very much in mind, and always exercise your rights if you are if you are preparing a special purpose report. Taking one more minute, some things that are very, very essential is always have an engagement letter for every assignment that you do. I often say this wherever I actually have an opportunity to interact with people. So please look at the SA 710, SA 210 implementation guide on engagement letter. The very elaborate form of engagement letter is given, which actually contains some of the important contractual clauses, which are rights of us as service providers, something like a limitation of liability, indemnity, confidentiality, breach of contract, and all these things. Please ensure that you make the complete engagement letter, at least take that format that is there in the implementation guide, and ensure that you issue an engagement letter for every assignment that you do. It can be a certificate, it can be a limited review, tax audit, or it can be an audit report. Please ensure that you issue a engagement letter. Why I am emphasizing on this is that, these are contractual terms and these are binding on each other. We have standards of auditing, but it is necessary to sign the engagement letter, which is a contractual term wherein you bind that what is the management responsibility, what is our responsibility, what happens in case of wrong information is provided to us, and what is our limitation of liability, and what is our indemnity. Okay, these are the things that should very clearly come out. So take a minute and then always issue an engagement letter for every engagement that you are carrying out. Okay, having said that, let us go to the flow of audit report. Let us spend 10 minutes on the flow of the audit report itself. Okay, so what is the first one? That is the title. To whom is it addressed to? General purpose financial statements in case of a company is always addressed to the shareholders of the company. In case if it is special purpose, it is addressed to the set of users who want to exercise that. For example, board of directors or someone like that. In general purpose, it is always to the governing body or the appointing body, who is more AGM. One more minute in terms of audit report. This is not only company's audit report format under SA 700 in I think illustration 3 or something. It also gives format for non-corporate entities. So if you, so all of us are aware that there was a technical guide on non-company FS and LLP, and now there is a guidance note on non-company FS and guidance note on FS of LLP, which actually gives a format of financial statements itself. So if you are preparing, if you are auditing LLPs, partnership firms, proprietary concerns, it is now on us, because guidance note is binding on us to be we should follow that guidance note in a true spirit and give all the necessary disclosures. And then the audit report format for a non-company entity or a LLP or something is there in one of the illustrations of SA 700, so you can pick up from there. There are slight modifications. Some paras are not there as compared to a company financial statements. The 143.3 section will not be there. But if you are doing under a regulation like a Bombay Trust Act or something like that, then you are free to include that under the legal and regulatory matters. So you have to take care of these specifics. Okay. Then the addressee to whom you are addressing it, so that will come independent. The title is like independent auditors report. So independent auditors report is very important. You can't write auditors report, which we used to do earlier. Now it is independent auditors report. Addressee, we have to pull out the addressee. That's what we discussed, that it has to be shareholders of the company. Then the next thing that we all know that from the last 3 to 4 years, the opinion is inverse. Many people, we still call it is inverse, because earlier opinion used to come in the last. You had to search for where is the opinion, is it clean or otherwise. Now that is why it's optically very easy to notice that if it is an opinion, it is on the top. That is the first thing that comes. So what happens when it is a clean opinion? You directly give the heading opinion. And what happens when you have to give a qualified opinion? The heading itself changes to qualified opinion. So I would like to state here two important things. One is the headers are very important. So when you say opinion, then it comes as basis of opinion, okay, in the flow. But when you say qualified opinion, it has to come as basis of qualified opinion. Similarly, disclaimer of opinion, then it has to be basis of disclaimer. Then adverse opinion, basis of adverse opinion. So that is how it has to flow. What are the common mistakes that we generally see in the audit report? Opinion is the heading that is given. However, when we read the opinion, it is actually qualified opinion, and then below there is a basis of qualified opinion. This mix match is not appropriate and is not permitted also. If you are issuing a qualified opinion, you have to term the heading itself as qualified opinion, disclaimer, whatever it is. Okay, so that we have to take care of. And when we say that it is a qualified opinion, certain wordings inside that change accordingly. So we have to pick up the right illustration from 705 in that case. So 700 talks about all clean opinions. When we are issuing a modified opinion, we have to pick up the example or the illustration from 705. And there is an implementation guide of that also, which has various examples. We have to pick up the appropriate slide, appropriate template from 705 or 706 in case of EOM. EOM is not a modified opinion, right? Because we write below, our opinion is not modified to this effect, right? So we have to pick up the appropriate opinion template, which is very, very important. So I am just dwelling upon these points because these are very basic, and these actually have a impact as such on the overall presentation of the auditor's report. If I look at auditor's report, I always see it as the final deliverable, which is true, right? So that is the final product of all our hard work and all our work that we do, and it has to be correct and it has to be appropriate. If something goes wrong in it, then obviously we are held responsible for it, because we should have exercised appropriate care and caution there. The next para is basis of opinion. We discussed along with opinion that if it is qualified opinion, then this will be basis of qualified opinion. If it is only opinion, then it is opinion, and if it is disclaimer or adverse, as the case may be. Then the next para is about material uncertainty related to going concern. Now, this is not a mandatory para in every report. However, as per your SA 570, if there is a material uncertainty, okay, then you have to put a para, there's a placement in the report itself, which will give you a material uncertainty para. Now, this is not an EOM anymore. Earlier, material uncertainty used to be either a qualification adverse or a EOM. Now, it is not an EOM anymore, and there is a MUGC para specifically, which actually talks about whether there is material uncertainty with respect to going concern or otherwise. So, this has a specific placement and it has to come over there. And if it is a qualification with respect to material uncertainty, then it has to get shifted to the qualification para. And also under the MUGC para, you have to actually give a proper reference that it is in the qualified opinion. Then the next thing is EOM, right? After this, if you have qualification, basis of qualification, then you'll modify again accordingly. Then you have EOM. Emphasis of matter. What is emphasis of matter? Emphasis of matter is something that is already presented by the management, and we are only drawing attention to it. So there is a long note on merger acquisition, and then we are only drawing emphasis on to that user, please go and read that and then read my report, because that's a matter that is significant that I want to emphasize on. Okay, when we are doing a qualification, few things are very important. because as per 705, there are 3 to 4 things that are very important in keeping in mind when we are drafting. Number one is what is the area that is affected. We have to very clearly bring out what is the area that is affected. For example, inventory valuation. We generally do it at cost or NRV, whichever is lower. So say for example, NRV is not available. So you want to qualify for that. What is the area? So you have to say inventory amounting to so and so. Why amounting to? Because 705 says you have to always quantify. So the company has to first provide you the information on quantification. If company does not provide you, you have to calculate. If it is not possible, then only you will write it is not possible to calculate. I'll come to that example also. So when we say first area, second is quantification. What is the amount that is getting affected? Out of which what is the amount that is actually affected? So it is the total value and the affected value, or directly the affected value. Third important thing is what is the problem? That means where is the non-compliance? So when we draft a qualification, many a times clients come back to us, don't use the word non-compliance. Don't use the word not in accordance with. So sometimes we have to be putting it out very loud and clear that this is a qualification. It will have a word which will say it is not in accordance with, it is non-compliance with, it is not in line with. So something there you have to say inventory amounting to so and so contains rupees so and so, which is not provided for example, or NRV is not, we are not able to calculate, and accordingly the inventory valuation we are unable to rely upon, the value of inventory we are unable to rely upon, and which is not in accordance with accounting standard. Or in case if it is a major companies act issue, then it is, say for example, section 73, and if it is a deposit, something like that, then you have to bring it out that it is not in compliance with what. Many a times when you read the qualification, the crux of it is missing. Either only area is written or some vague language is written, and many a times qualifications seem like notes. Notes are different and qualification are different. Notes is explanation given by the management. Qualification is pointing out what is the problem. If management has given a note to that effect, generally at the end of the qualification, we write it in brackets. One very important thing to note is that qualification 99% does not start with we draw attention to. It does not start with we draw attention to. That is the customary practice. Now, where is it written? It is not written in clear words, but it says that but it is a general practice that it never starts with we draw attention to. When you're saying we draw attention to, it is more on emphasis side. It's not on qualification side. So three important things to note in qualification: area, quantification, and then the non-compliance. And of course, the quantification also relates to profit overstated, understated, asset overstated, understated by so and so. So that's the way we should do the qualification. Coming to emphasis of matter, we're drawing attention. So the elaborate note is there in the notes to accounts. We can't do an emphasis without a disclosure by the management. That is a given. Management has to give note, and then only we can do emphasis. If they have not done, we cannot do qualification at all, right? So that is another important thing to note. So the emphasis of matter generally starts with we draw attention to. Note number so and so, we state so and so. So here you kind of make a crisp presentation of what is it that the note says. You don't have to completely reproduce the entire note, but then you can only crisply add what is it that you have to that you want to emphasize on. So that you have to bring it out, and also state that because of that, if there is any other area that you want to emphasize, so you can add that, and then you should say our opinion is not modified to this effect, because that statement is very, very important. You have to say that our opinion is not modified to this effect, and that's a very very much necessary statement, because that gives the conclusion of the matter in a way. Key audit matters. We all know about key audit matters. I'm not going much deeper into it. This is an item which is actually not a qualification and not an EOM, but it is a significant matter which I have exercised, which the management has exercised more judgment or more critical or a complex matter, wherein I have done more procedures. So I write the procedures and I put out the matter, but I don't give any individual conclusion saying that this matter is fine. For example, if the company has a derivative and then they have taken some expert valuation for derivative, and then I have tested it through my assessment or my expert or something like that, I put it out there, but I don't give a separate conclusion saying, oh, derivative area is fine now. I don't do that. So that's the CAM. Now, there was a time when people used to think, the audit report was fluid. I'll put it this way, that audit report used to be fluid. Placement of a matter somewhere in the audit report used to be considered as, I have put it somewhere. So it's not missing from the audit report. Gone are those days. Now we have very specific compartmentalization. We have very specific header. If it is a qualification, it has to appear as a qualification. If it is a EOM, it has to come as a EOM. We can't give that justification that somewhere in the audit report it is sitting, so I am fine. Everything has a placement and it has to come under that specific matter only. There have been a number of observations, if you see, from NAFRA, QRB, I think FRRB, everywhere, that matters which are actually qualifications are put as EOM. Why do they say that? Because non-compliances or matters that are not in line with the accounting standard, auditing standard, or non-availability of information, non-disclosure, all these things cannot be EOM. If they are material, or anything will come into audit report only when it is material. If they are material, obviously they will go into qualification. So EOM is not a place where we can say that it is there in the report, so I'm not going out of the reports, it is staying inside the report. No, that's not done at all. If it is an EOM, it has to come as an EOM, and if it is a CAM, it has to be a CAM, and if it is a qualification, it has to be a qualification, as the case may be. Then the next part is information other than the financial statements and auditors report thereon. So this is basically our SA 720, right? So here you have 4 options. So I have often seen problems in this clause. Why I'm saying that? Generally, we tend to copy paste some of the reports or take reports from the public domain. So things that are there in public domain are mostly listed companies. So there are 4 options inside this standard. For listed companies, you have got the other report, that is board report, management discussion and analysis and all that things. You have got it, you have not got it. If you have got it, you have read it, you have compared with the financial information, there is no inconsistency, you report it that way. You have not got it, you have to make a statement to say that I have not got it. But if at later stage, if I discover something, then I'll come back and report. For not a listed company or a PIE, you have public interest entity, you have another option. You have got it, you have not got it. If you have got it, please read, compare, and then write what is the inconsistency, or if there is no inconsistency, make a statement. If you have not got, you are not obligated to read later and then again come back. So what happens in case of private limited company also, people tend to take it from the reports that are available from the public domain. Most of the things in the public domain that are available in the month of April, May, they have this statement that we have still not got. When we get it, we will compare it and we will write it. So you are unnecessarily taking an obligation which is not supposed to be taken, which is not required at all. You can simply write, I have not got it, and there's nothing much required in case of a private limited company. If you have written that I will read it and come back, which is voluntarily you are doing, then you have to do it and document it. So that's the difference that I see. But when we review or when we ask the question, it is said that, oh, this is a private limited company, I'm not obligated to do it. Agree, you're not obligated to do it, but then why you have written in the report that you will read it and see if there is any inconsistency. So please understand the standards and please exercise the proper options here. Then the management responsibility for preparation of financial statements and the auditor's responsibility. Again, in auditor's responsibility, there are the list of the auditor's responsibility, the 8 to 9 statements. You have to be appropriately careful in that. One is there is one statement which talks about IFC. If IFC is there, then that statement gets modified. If IFC is not there, then the statement gets modified in a different manner. And also, if it is a special purpose report, one of the statements get deleted, and if it is general purpose report, this statement stays there. So it is, you have to read the standard. And when we ask someone in the office to, just download few reports and compare, we have to always start from the standard. Always start from the standard. The reports of other companies are for reference and for comparison, but the starting point has to be the standard, because that is how we can avoid the mistakes and be specific as much as possible. Other matter is something that is related to the audit or the auditor. It is not something, it may be presented in the financial statements, may not be presented in the financial statements, but it is more about the audit and auditor. So that is also part of 706. Audit and audit. So for example, I am the first year auditor this year. Someone else was auditing this company from the last 6 years, 7 years, whatever. So even after doing the opening balance testing and taking an NOC from the earlier auditor, I should write in the other matter paragraph that I am the first year auditor. Earlier year, the audit was done by so and so, and then he has issued a modified opinion, qualified opinion, clean opinion, whatever. We have to bring that out. Another example is, physical verification of inventory. If I was not present for observation of physical verification of inventory, which is one of the mandatory procedures as per 505, then I should bring it out in other matter. We should say that I have not done. However, I have done alternate procedures to satisfy myself. That is only if you are satisfied. If you are not satisfied, then obviously you go back to qualification. Right? Then, the report on other legal and regulatory matters, 143.3. I think 143.3 was 5 line items, then it became 6, 7, 8, 9. Now it has gone up to so many, right? So there is managerial remuneration, there is CARO, there is IFC, then there is 164 to the director's disqualification, rule 11E, 1 to 11F, everything over there in 143.3. Now, what is the point that I want to emphasize over here is that we all have to read the audit report from the beginning to the end and from the end to the beginning. What do I mean by that? So audit report, let us say we have main audit report, we have IFC, and we have CARO. Okay. So there are some clauses which may impact each other. For example, if there is a major non-compliance in section 73 or 185, 186, and if interest-free loan is given, something is done, or if deposits are taken and no proper procedure is done, no controls are there, for example, it may affect true and fair view. So when we are reporting it in CARO, second thought is to be given whether it is affecting my true and fair view. So that is a reverse reading, right? We have made the report. Now we go there. We think that, okay, these two items have an impact on the true and fair view. Then we have to come and modify our report. It becomes a qualified opinion. Similarly, IFC report. Our guidance note on IFC says that controls may fail while you check the operating effectiveness, but still by doing substantive test, you can still do the audit and main report may not be qualified, right? However, if the control failure is so significant that that area itself has a problem, for example, something relating to purchase, there is a major failure in the control and then you don't know what is the component of purchase in the COGS or the cost of sales, then your main report gets impacted and obviously your true and fair view has to be rechecked. So this is again an example of reading reverse. Also reading from bottom up to top bottom. So if you are saying, for example, the same example I'll take, inventory. Inventory, you are qualifying for valuation according to AS2. Then in 143.3, you have one clause which says that whether the financial statements are prepared in accordance with the accounting standard, right? So There you have to say except for the above. So when you put a qualified opinion, all these 8 to 10 items, 12 items become except for, except for. You have to carefully evaluate where the except for will come and where it will not be there. Okay. Another example. Now daily backup of accounts is mandatory, right? So you have a clause in 143.3 which talks about whether books of accounts are properly maintained. Now daily backup is part of section 129, which is books of account. If that is not maintained, that will be qualified. However, if it impacts true and fair view, it will go up. Otherwise, it will not go up. So these are the kinds of reading from end to beginning and beginning to end has to be done at least twice so that appropriate opinion is issued. Sometimes opinion is qualified for no receipt of information on certain areas. Then when we see whether all information explanation is received, they are saying everything is received. They don't tally. There's an accounting standard qualification. Books of accounts are prepared in accordance with section 133. That is not done, right? There is an IFC qualification on something which can have a true and fair view. Not sure how it is not taken into true and fair view. So CARO qualification on PPE, but no main report qualification or IFC. So I'm not saying everywhere it has to be there. It is mandatory, but this style or this type of reading is necessary. Otherwise, we may end up in issuing a inappropriate opinion, right? The last thing on the audit report is signature, UDIN, place and date. So signature, we all know the signature block or FRN, MRN and things like that. UDIN. UDIN can be generated within 60 days of issue of report, right? So UDIN is to be appropriately generated for the client with the appropriate description. Not everything is auditor's report, not everything is certificate. So that summary you have to actually appropriately take. And also you are aware of the recent notification that you can't revoke a UDIN after 48 hours. So you have to be careful while filling the UDIN details and the place and date where you are signing. Okay. If you are in a different town, you have to put the respective place and date. And you can sign after the company signs. You can't sign the financial statements before the company signs. You can't have different dates of financial statement signing and audit report signing. Company can sign on a different date, you can sign on a different date, and you have to do subsequent event, but you can't have financials yourself being signed by on a different date and audit report on a different date. We all have seen various messages or news clips or something that ROC is also penalizing and ICI is also taking actions against improper signing and improper things that are being done. So this place is very important and we have to take care of this. Okay, I think many of these things we already discussed. Title, what is missing is mostly independent auditors report, addressee, statutory audit report, its members, special purpose audit report, it is board, management, group auditor as applicable. When we come to opinion, ET to consider, ET means engagement team to consider and based on consideration of reports of other auditors on separate financial statements and on other financial information of subsidiaries associate while CFS is applicable. What does this mean? That wherever CFS is applicable, appropriate disclosure is to be given that what all reports, if other component auditors are being used, whether the reports of those people are being taken into consideration or not taken into consideration is also very essential to note. So that is why accordingly it is, we have to populate this in the console report. Also, the engagement team has to update the company's Indian accounting standard rule or accounting standard rule as the case may be. So sometimes it is Ind AS and the reference given is accounting standard and vice versa. Also, profit and loss. This may sound silly, but it is necessary that if it is a profit, you have to write profit, and loss, you have to write loss. And also, in case of loss, have a recheck whether your MUGC, that is material uncertainty on going concern, is getting affected, not getting affected. Do not use the word subject to. It doesn't exist anymore. Once upon a time, we used to write that, but now it is very crisp and clear wordings that are being used. So there is nothing called subject to as such. So even in the 143(3) clause, we generally use except for, we don't say subject to. Because subject to becomes too subjective. Except for is very straightforward, that except for this, everything else is good. So that's the crisp summary of how we have to draft the opinion basically. Now, coming to basis of opinion or basis of qualified opinion. Basis of qualified opinion should not start from withdraw attention as such. It always starts from say this area amounting to so and so. So withdraw attention is generally 99% for EOM. Reference to note in FS to be given, but matter is to be explained in the qualification para only. Qualification we can give even if the company has not given in their financial statements, we can actually do the qualification. If note is given, we can only put it in the brackets. Appropriately explain the matter giving rise to qualification. That's what we discussed. The quantity, the area, the quantification, the area, and the non-compliance. Or when we are unable to obtain sufficient appropriate audit evidence for a certain area, then it becomes a qualification. Avoid using words something like management is confident that this will get appropriately done. Management believes that this is fine. These are not something that should be part of your qualification. Qualification is a qualification. That means something not done, you are saying that this is not done. Okay, it's not in compliance with something, this is not appropriate, so put it out there. Don't try to kind of cover it up with saying management is confident that this will overturn, management says that this is fine. These are not part of qualifications generally, per se, if you read the standard in spirit. Impact is to be quantified always unless impracticable. When it is impracticable, you write the whole qualification and then say the amount at present is unascertainable. Two things very necessary here. Amount at present. At present is very important. So later it may be quantifiable. Now I am trying to quantify, I am not able to quantify. Unascertainable. As of now, it is not calculatable. I made an attempt, but I could not get it. So that is how you conclude it, right? Then if it is a continuing qualification, please highlight that it was also qualified in the previous year, right? That's also necessary. Then you can use various tools like green tick, some other subscriptions and things like that. But then avoid copy paste, always start from the standard, right? Whatever it is, you always start from the standard. In case of multiple qualification, what is important for us to assess is whether everything taken together becomes so pervasive that it is actually turning into a adverse opinion or a disclaimer of opinion. This table, I would say I printed this and pinned it on my desk because this is so essential, we can't forget it. If the nature of matter giving rise to modification is material but not pervasive, then it is a qualified opinion. If it is material and pervasive, it is an adverse opinion, and you're not getting the information for one area, maybe it is qualified opinion, and if it is multiple areas and it is pervasive, it is disclaimer of opinion. Let us take two examples. First example being a normal balance sheet, okay, manufacturing company balance sheet, okay. PPE is qualified. I'm taking simpler areas which we all see in all the financial statements. PPE is you're not getting FAR depreciation calculation, you're not comfortable on. So one area, everything else is okay. So that becomes qualification. Same PPE in a capital intensive company, out of say 300 CR balance sheet, 220 CR is your capex, and that's sitting in CWIP, and no breakup available, no information available, it becomes pervasive. And if information is not available, it is disclaimer. Information is available, but everything is wrong, then it is adverse, right? So we have to always think Single area, okay, cannot close our eyes and say single area always qualification. Single area also whether pervasive, no. Then qualification, yes. Information available, information not available, disclaimer or red bus. Multiple areas, maybe qualification, all put together, how much pervasive? Say PP is also qualified, inventory is also qualified, your receivables are also qualified, all put together, it is 85% of your asset, for example. Then it is pervasive. Now, can pervasive be calculated on the basis of P&L also? Yes. There can be some entries, if taken, profit will become loss or loss will become eroded net worth. Then that is again pervasive. So we have to make this calculation and see. Against the balance sheet, we have to write what all areas are qualified. Take an aggregate. P&L, what all areas are qualified, how much is profit impacted. Take an aggregate and then see whether it is material or pervasive. This activity, wherever there is a qualification, this activity is mandatory irrespective of the size and nature and complexity of the balance sheet and the company. Okay, I have put across few examples of going concern, that is MUGC going concern plus qualification combined. Here there is a qualification on account of going concern. So one example is as stated in note number so and so, company has accumulated losses, net worth has been fully eroded. So these are the default conditions for going concern. Also incurred losses during the year. It has defaulted in payment of principal, interest, secured creditors, so and so, contingent liabilities, everything. At present, company has no source of funding available. It tried somewhere, but it is not available. All these conditions in aggregate raise substantial doubt as to the company's ability to consider this thing. The accompanying financial statements do not include adjustments relating to recoverability or classification of asset and liability. One question that comes is if this is the size of the qualification, it can even become an adverse opinion. However, if there are no major items on the balance sheet, only receivable, payable, and things like that, it can stay as a qualification. Now, again, that is a professional judgment one has to do, and you have to calculate very specifically. Next example is during the current year, all employees have left the company except one director. Okay. This actually happened in few cases if you ask for in COVID time. Further, management has also significantly curtailed operations of the company. Basically, they are on winding up mode. So these conditions indicate that there is a material uncertainty. Financial statements do not adequately disclose, and we are unable to comment on the impact of the same on the financial statement. That's why it becomes a qualification. If there are major items, again it will become adverse. If the items are lesser, then it becomes a qualification. So few examples of how you actually deal with the qualifications. Another qualification, say on PPE, management has assessed that PPE having carrying amount of rupees so and so has not suffered any impairment losses basis future projection and so and so. And they have actually gone to some recovery tribunal and things like that. Inclusion of cash flow for these events are not in accordance with Ind AS 36, impairment of asset, and impact is presently unascertainable. So all the three items are coming. That's non-compliance, area, as well as what is the impact of this, and also the note number reference is given, which is a similar case in the earlier this thing also. Going concern qualification, again area, impact is pervasive. That is why impact is given like this. And as we discussed, it may be an adverse opinion or it may be a qualification if more items exist on the balance sheet. Excuse me. Then the next content of the audit report is material uncertainty relating to going concern. Preferable to use language in line with the notes that are circulated by implementation guides that are circulated by the institute. State matter that is giving rise to uncertainty and also the mitigating factors. So there are two things to it. If you see this slide, first is you assess the going concern. What are the indicators? Net worth, profit, loss, things like that. So you make the ratio calculation, you make all those things. First, you see whether the company can stand on its own feet. The moment you decide the company is not able to stand on its own feet and it will need some support from somewhere, some crutch from somewhere, you have to bring in MUGC para. For example, there is loss, there is net worth is getting eroded. If these conditions exist, then it is necessary that you fall back and then say that there is a material uncertainty relating to going concern. However, the company may get, the promoter may fund, the holding company may give support letter. So those things will make you understand that, okay, there is someone to support. So if you cannot stand on your own feet, put up a MUGC para and then substantiate that there is a support letter or some other mechanism that is available here, which is a mitigating factor. Assess and obtain audit evidence with respect to financial capacity of the party providing the support also. So if it is holding company and if the holding company is providing support, you have to assess that company also. So that company's balance sheet, say for example, it has going concern. So they cannot beg and actually they cannot support someone else. So you cannot rely there. So that becomes an adverse opinion or a qualification there. The person who is giving the support has to be financially stable. If that is not there, then you can't give a clean report. You have to put a MUGC para and that becomes a qualification. More than MUGC, it becomes a qualification. Next important thing is your CARO also asks about going concern, directly, indirectly. So you can write in CARO that it has losses, it has net worth eroded, and in the main report you don't have a MUGC para at all. So that's an inconsistency which has to be appropriately worded and it has to be avoided at all times. Example of MUGC. This is a standard type of drafting MUGC. We draw note attention to note number so and so. Company should give note. When material uncertainty is there, company has to give note. What is its plan? How is it going to go ahead? How is it going to, sail through in the future? All that. It is necessary for them to give this note. Okay. So we draw attention to note number so and so of the financial statements. It states a company has incurred loss of so and so during the previous year. It also has accumulated losses as of 31st of March. It has got the net worth eroded. Further, current liabilities exceeding current asset. All these conditions indicate material uncertainty on the financial statements as on this day. However, company has received, holding a letter of support from its holding company, confirming necessary financial operational support as may be required to enable its business operation. In view of these, financial statements are prepared on going concern. Two things to state here. There's an implementation guide on 570 also, SA 570 also. It has a format of support letter also. So please go through that. If someone is issuing a support letter, ensure that it is unconditional. Support letter should be unconditional. It can't be said that it has to be for only this much period or things like that. Support letter mandatorily has to be unconditional. That is one thing. Second thing, documentation of going concern. At the beginning of the audit, that is at the planning stage, the simple checklist that we have, ratio indicators is one sheet. And then the basic questions, whether the company is going through any struggle, major supplier loss, major vendor loss, major things happening, company key personnel leaving. So those questions which are already there as an annexure to SA 570 and also in the implementation guide. It's a simple checklist. You need to fill in that. You need to ensure that you are in compliance with it, evaluate going concern at the beginning and also at the end. And if there is any indicator, you have to put MUGC para. If you have support, then evaluate the support as well. So this is very, very essential. Most of the companies, if you see, wherever there is a review or other things, they always, any reviewer, whether in India or in some other country, I have always seen this as a theme of review. Going concern is a standard theme of review because that's the basis on which the financial statements are prepared. If that goes wrong, then many things go for a toss. So it's necessary that you actually look into very much in detail. Okay, let's come to EOM and other matter now. So 706 deals with EOM as well as other matter. EOM, we draw attention to a matter that is already presented or disclosed. So there is a matter, for example, there is a merger acquisition happening. There is a major event in the company that is happening. So why is it necessary for me to draw emphasis? Because I want the user to read that note when they read the financial statements, because this is a major thing that has happened. So I'm emphasizing the matter. So emphasis of matter is something that draws attention of the user to certain things. It is not a substitute for a modified opinion. It is not a substitute for disclosure in the financial statements to achieve fair presentation. Reporting in accordance with SA 570. Let's look at it, each of these. First one, I think we discussed very much in elaborate. EOM is never a substitute of modified opinion, because below EOM, we very clearly write that there is no effect of this. Our opinion is not modified to this effect. We very clearly write that below the EOM. So anything that is a non-compliance, that has a quantity impact, that has anything to do with any law and regulation non-compliance, everything is a qualification. It cannot be said that somewhere in the report it is sitting. I know I'm repeating this 2-3 times. We cannot take that shelter. It has to be there in the report as a qualification, if it is a qualification. Also, this is not a substitute to disclosure in the financial statement. Disclosure in the financial statement is management's responsibility. They have to disclose everything. If they have not disclosed a material matter, again, you can qualify for disclosure as well. So EOM is nowhere a substitute for disclosure in the financial statements. And also, it is not a substitute for reporting in accordance with 570. Few minutes ago, we discussed so much elaborately about 570. EOM is not, earlier going concern used to be an EOM. Now there is a separate placement of MUGC. So EOM is not a substitute of going concern at all, right? These things have to be remembered at all time. Other matter, this is something that is related to audit and auditor, other than those presented or disclosed in the financial statements, right? Other matters does not include that required to be disclosed or presented in the financial statements. Management would have disclosed it, but then they missed it, so I am putting in my report. No, it's not a substitute for disclosure. Information that is required to be provided by management, some information that management has to provide as per the law and regulation. Other matter is not a substitute for that as well. Other matter cannot be put up for some information that is prohibited from providing a law, regulation, or other professional standards. So this is there everywhere. If that is prohibited by the law to be put in the report, then you can't put it like this. EOM, few tips. Always starts with, we draw attention to note number so and so. That is the beginning. If you have multiple EOMs, we draw attention to, and then a colon, note number so and so, note number so and so, note number so and so. That's how it flows. Quantify the figures wherever possible, wherever applicable. What is it? How is it? What is it relating to? Don't make it too short. No one has told us that it has to be in 2 lines only. It can be 4 lines, but it can't be 2 pages. We have to maintain that balance. It can't be everything that is written in a note, at the same time not too short that no one will understand anything. So it has to have a combination. For example, some people say, we draw attention to note number so and so regarding PP in the financial statement. No, that's not done. What in PP? You have to give a little bit of detailing there, right? And it's not even necessary to give all the 2-3 pages continuously. If this matter was also emphasized in the previous year, you need not again say that it was there in previous year. However, in case of qualification, if it is continuing, you have to say that it is continuing qualification. Why? Because that says that, this was a problem in the company last time, but they have not corrected it as yet. So it is a continuing problem. Here it is not a problem. So say, for example, a merger acquisition. EOM may continue for 2 to 3 years. One, when the scheme is launched and when the scheme is filed. Schemes don't come out in 2-3 months. At times it takes 1 month, 1 year. and 1.5 year, or sometimes it spills over more. So next year also EOM, and third year when the scheme gets implemented, then also an EOM. So it may continue, but then you don't have to say that it was existing in the last year, because the content may slightly change. It is always related to a matter that is already disclosed in the financial statements. You can't give an EOM if the matter is not disclosed in the financial statements. Always remember this as a thumb rule. You can't give an EOM for something that is not given in the financial statements. Reference to a note to be given, but not a copy paste of the note. We discussed this. Do not copy paste the entire note. Reference of note is to be given and format in a crisp manner. One of the NFRA observation, EOM was inappropriate and soft reporting is a serious matter. Okay, that's not appropriate. Yeah, you have to say it, you have to call a spade, basically. You have to very clearly say that it is not the same thing. Sorry. Yeah. Example of EOM, we draw attention on some other matter on, say, merger, which describes, the financial statements which describes the effect of demerger. On so and so date, board of directors did this, approved the scheme. This is the resulting company. This is the demerged business. Scheme has been approved by the company law tribunal. Demerged business undertaking stands transferred, so and so everything. And how is the capital reserve, goodwill, everything is adjusted. So this is a typical EOM. Which starts with we draw attention to so and so. That's more on the drafting side of it. How do you draft it? In a crisp manner. In the note, I know you will have details of the scheme, what are the assets taken over, what is the liability taken over, how is the goodwill calculated, where is it debited, credited, and what is the effect of the scheme on the financial statements, and if it is Ind AS, then whether it is, Appendix C or otherwise, all that detailing will come properly. Another example of EOM, inventory amounting to so and so is not physically verified by the management. Further, we were unable to gather sufficient and appropriate audit evidence through alternative procedure with respect to said inventory. So actually, this is given as a contra to the EOM. This is not an EOM. This should have been a qualification which is written like an EOM. So this is actually not an EOM. So there was 1 or 2 reports wherein these kind of, so we discussed this point. Last one, EOM was inappropriate and soft reporting of a serious matter. So something to give an example, this is put up. This actually, if you see, is not an EOM. However, it is worded like an EOM. It has to be a qualification. Physical verification not done. We haven't got sufficient appropriate audit evidence through alternate procedure with respect to said inventory. Also, we are unable to comment on the existing value of inventory and impact, if any, on the financial statement. So this is not at all an EOM, but however, it is worded like an EOM, right? So this is a very clear case of qualification. Now, we come to a very typical matter, which is no going concern audit report. What do we mean by that? At times, companies into IRP, companies into liquidation, IRP, not all cases of IRP, I'm saying. Few cases of IRP, liquidation is for sure. Company actually does not have anything which is otherwise non-dilutable and things like that. Company is in a closing mode. So we come across situations where financial statements are prepared on no going concern basis. That means liquidation basis. Common question, how do you prepare the report? Whether it is qualified, disclaimer, or adverse. Any thoughts? Anyone in chat? Whether it's a qualified, disclaimer, or a normal report or a clean report. Any thoughts here? Liquidation basis report. I'm waiting for 10-15 seconds to get some answers on the chat. Have you got anything? Have you got anything on the chat? Okay. Okay. One or two answers directly to me that it is not a no going concern. So it is a disclaimer. No, there's nothing like that. It's a clean report with only an EOM on no going concern. Management responsibility para will change. Audit responsibility para will change. Now, this is not given in any standard, but this is just a way of drafting, I can say. So the examples of EOM on no going concern, we draw attention to so and so, which states Board of Director has proposed to initiate the process of winding up of the company voluntarily. As there is no business for last 2 years, management believes there is no possibility of revival of the company in future. Hence, going concern assumption is considered inappropriate and financial statements have been prepared on liquidation basis. Accordingly, assets are stated the amounts at which they are expected to be realized. Liabilities are stated at values at which they are expected to be settled. This is an EOM in the no going concern report. That means a liquidation basis report. Another example is we draw attention to so and so company is not doing this. Accordingly, it is considered inappropriate and everything is on realizable basis. How does the management responsibility para change? In preparing standalone financial statements, Board of Director is responsible for assessing company's ability to continue as going concern. Accordingly, company's management has prepared financial statement on net realizable value basis of accounting as the company ceases to be a going concern. This will be the change in the management responsibility para. I repeat, it is not given in any of the standard. This is my interpretation and how we have drawn the report. Okay, this is just for reference. It is not there in any of the standards, but this is how a liquidation basis report will appear. And similarly, in the auditor's responsibility para, the last sentence, as stated in EOM para of our report, the financial statements are prepared on net realizable basis of accounting since company ceases to be a going concern. So there is a change in the management responsibility para as per the standard itself and the auditor's responsibility para and then the EOM. Otherwise, the report remains clean. This is how the liquidity basis report will be prepared. So one question, is it advisable for an auditor to highlight all significant matters and transactions that affect financial statements as emphasis of matter? Whether it is yes or no. Answer widely is no. Widespread use of EOM is diminishing the effectiveness of auditors' communication about such matters. So it has to be used quite judiciously, right? Information other than financial statements that are and auditors report their own. Testing of other information should be documented. That is what we gave as 4 options in case of listed company. In case of unlisted company, if you have tested the other report like management discussion and analysis, board of directors report, all that thing, you have to document it on the file because this is one of the points of NFRA also that these are not properly documented. In case of qualification, you have to describe the basis of qualified opinion in brief or give reference to basis of qualified opinion in case of multiple qualifications. So you have to actually take care of that qualification and the explanation by the board. Update types of other information factually as applicable. So to few of the companies, few of the things are not applicable. For example, BRSR is not applicable to all the companies as of now. So if BRSR is applicable, then you should write. Otherwise, you cannot just keep writing that 1, 2, 3, 4, all of them are applicable. Pick up only those that are very much applicable there. Key audit matter, we spoke about it in short. How did you assess the CAM is something that you have to look into. One important thing to note in case of CAM is if no CAM, then assessment should be documented in the requisite template or document, whatever you have internally in the firm. Then CAM versus EOM, CAM is not a substitute to EOM and EOM is not a substitute to CAM. Very, very rarely you can have the same matter as CAM and EOM. It's very rare, but it is possible as per the standard. Audit procedures performed and document should form part of CAM. Another thing is that you can't write two procedures in the CAM, but which you have not performed. That's not allowed. The audit procedures should always match with the CAM. Responsibilities of management and those charged with governance. So wherever those charged with governance or board of directors, both options are possible. You have to use these words very judiciously, appropriately. It's not to be used very much lightly or loosely. Auditor's responsibility for audit of the financial statements in respect to IFC. It is generally annexure A if it is there. As we discussed, we have to update IFC for any qualification. Appropriate cross-referencing. If instead of A, if you make CARO A and annex IFC B, then you have to change it accordingly. Otherwise, there will be an inconsistency between in your report itself, right? Other matter. A few tips on other matter which we have to consider. Financial statements versus financial information. That is, wherever you are stating that it is an interim financial statement, interim financial information, what is the information that you have taken? You have to appropriately word it. This may be a case in case of different gap conversion adjustment, and then you have tested the gaps and documents. For example, you have two subsidiaries in Germany and then there is a gap difference and you have tested it, then it becomes part of other matter. Total assets, total revenue, you have to take without elimination. This is with respect to consolidated report. So in consolidated report, when you use the audit of for the audit of components, when you use a component auditors and you are writing asset, liability and things like that, you have to use the net. That is without elimination, not the net, but the gross, which is without elimination. The total amount that you write that we have not audited the components amounting to revenue, amounting to so and so, turnover amounting to so. Those are the things that are without elimination. Engagement team's assessment of what is not material to the group on quantitative as well as qualitative factors. You have to put a group toolkit or something like that, and then you will have to document that properly. In case of modified opinion by previous auditor, reference of previous year's qualification should be in brief, or it can be completely reproduced. That is with respect to if I'm the first auditor, either I can say he had qualified with respect to inventory PP of so and so, completeness of inventory, something like that. Or I can actually reproduce the entire qualification also in the other matter. First year report, then don't miss the standard para. That is, it is there in the illustration itself. So don't miss that standard para. It's in the opening balance testing standard. So please do not miss that standard para in the first year. Report on other legal and regulatory matter. So these things I think we discussed in brief. Whether we have sought and obtained all information, explanation best to the knowledge and belief were necessary for the purpose of this audit, if not details thereof. So whenever you have disclaimer, whenever you don't get information of a certain clause and you're putting it up in the qualification, this will get changed. Proper books of account, gave an example of 129, which is now backup of this. Next year it will be audit trail also. Both these things will get in proper books of account, right? Branch office, wherever it is applicable, this will come in. Balance sheet dealt with are in agreement with the books of account. If you have issues, then it will be different matter altogether. Financial statements, whether it complies with the accounting standard, that is again another thing to change, you will have to look at, just 1 second. Yeah, that you will have to look at as to whether it is as per the qualification or not as per the qualification. Okay. In the observations or comments of auditors on financial transactions and matters which have an adverse effect on the functioning of the company. This is an important clause. This doesn't come into picture all the time, but if you have disclaimer, if you have major things, then if there are operating issues, then those things will definitely come as having adverse effect on the financial statements. So that is how this statement will come. Otherwise, this statement generally does not come. Then the next thing is director disqualification. If any director is disqualified, qualification, reservation or adverse remark relating to maintenance of accounts or other matters connected therewith. So this will get modified according to your IFC or CAR or whatever. IFC report that we all are aware of, and any other matters that are prescribed. So few of the things that we have to ensure is, in case of qualified opinion, engagement team to report appropriately, except for the possible effects that we talked about. Books of accounts, we talked about daily backup. Basis of qualified opinion para, material uncertainty para, assessment on adverse functioning of the company should be documented. That is what we saw under this clause. It may come under this clause. We have to evaluate that wherever there is a going concern. So implementation guide on going concern says that wherever there is a going concern issue, your adverse functioning on the company automatically kicks in. Disqualification of director, look at on the close date of the financials only. Do not look at the next date, later date, and things like that, because there is a confusion that always prevails there. IFC applicability, not to companies that are not incorporated in India, only for companies that are incorporated in India. This is especially in case of subsidiaries. Always refer guidance note on 143(3)(f) and H. Okay, so this is what we discussed just now on director's disqualification. Then there is this rule 11E and 11F, engagement partner and the engagement team to carefully document reporting under this, as it covers transactions outside the group also. So this is a very delicate tenders, this thing that wherever you give money in the form of beneficiary, and if it is coming back to you, the entire chain needs to be reported, whether as a giver or as a taker, right? Daily backup we discussed, and from next year we will have audit trail also. 3 things to always remember in terms of audit trail. Your system should have it and you should enable it. Once enabled, you should not disable it. Second, you should be able to see the logs. Third most important is that no one should be able to temper or change the logs at all. These 3 things you will have to report, and you will have to see. If you can't see this, then you should qualify. Caro reporting, not going into the Caro clauses, just quick things on Caro reporting. Have a checklist, document in detail, and not only tick mark, please write for your references whatever you do. Whistleblower, always look into material and qualitative and quantitative matters, because it matters. It does matter. Even inventory, evaluate reasonable interval. Don't just write that reasonable interval. Try to evaluate that what is reasonable based on the size and complexity of the company. Physical verification, what is the reasonability? Adverse comments in Caro of holding companies Caro will come in consolidated report as well. So please remember that. Non-compliance with local law and regulation, if any, and if it is material, then you will have to consider. Then this is not the no-clar of code of ethics, but the non-compliance as such we check as a standard as well. Okay, so both together. Disclosure in FS does not substitute report in Caro. So whatever you report in Caro is different, and whatever disclosure has to go is different. Factual reporting, kind of short-term funds raised but stated that there were no short-term funds. These kind of statements should be looked at into very carefully. Resignation, rotation. So resignation we have to report on. Rotation is not resignation. If because of rotation some auditor has gone out, it is not resignation of auditor. So both things are different. Internal audit report, obtain it and please carefully evaluate it. And if there is anything that we have to state, please ensure that we state it. IFC report, internal auditor report observations have to be considered for IFC report. Impact of the same has to be taken care of while doing testing. Another thing is whenever we are issuing IFC report, all the major areas test of controls have to be performed. If we are not performing walkthroughs and test of control for the major areas, we are not supposed to issue a IFC report. Operational control versus financial control, we all are very much aware about. It's the control that is related to financial statements that we evaluate and not the operational control. Nature, timing and extent of audit test applied in our audit, it may affect, may not affect the opinion on the financial statement. So we have to document it. For example, ITGC, certain controls can be seen only when the things are moving and when the things are happening. It can't be seen later. So the nature, timing and extent of control testing is very, very important. And we have to take it into consideration while we are doing. Another thing in IFC is that there is also a school of thought that exists that whenever we have a qualification in the audit report, every time you have to have an IFC qualification. This is my view that it is not mandatory. There are certain things that may be a conscious call taken by the management, but it is not a failure of control, but it is not appropriate. So it has to be a qualification also. So vice versa also is not necessary because guidance note tells us that if a control fails, if you are doing substantive testing, you can still issue a clean report. The main report can be still clean. So there can be a combination of both. So that needs to be taken care of. But whatever we do, we have to document. And if we are issuing IFC opinion, then we have to do control testing and we have to do and we have to do all the walkthrough and control testing properly. Yeah. Consolidated audit report. So what we have in consolidated audit report, few things that we have to take care of. Other matter on the component audited by another auditor or not audited, consolidated based on management auditors, we have to consider materiality. So 3 types of cases: components audited by someone else, components audited by me, components not audited. If components not audited is major, then it can't be other matter, it will become qualification. Components audited by me, no need of other matter. If components not audited by me, then other matter, and then we have to make a combination. Components audited by someone else and by management, that is no audited. So this combination can also exist. So both should come under other matter. If it is a foreign entity under other gap and then I have converted it, then you have to give it under other matter again, right? Ensure qualification or EOM in the subsidiary. If it is material at the group level, is appropriately taken care of. So again, 2 school of thoughts exist. Everything that the subsidiary has done, I will reproduce in my consolidated report. Not necessary. If you read the standard, it says that how you have taken care of in the group report is something that you have to document. So if there are minor matters which are actually major for that subsidiary, but group as a whole, it is not major, then you will have to look at the assessment and then you will have to document for sure that why you did not take that qualification into the group. Going concern has to be assessed at the group level. You cannot say that subsidiary, for example, one of the subsidiaries having going concern issue, you are giving support letter to it. So you have to assess the going concern at the group level, and you should, that is consolidated level, and you cannot assess at individual level and then bring that in the group level audit report also. In case there is adverse qualification in the CARO of the respective component, also so in the parent consolidated CARO report, you will have to mention the same along with the names in relationship and clause numbers of the CARO that we are aware of. It is given very specifically in the guidance note. So these are some tips about the consol report. So some basic differences: 700 series, 800 series, no basis of accounting and restriction on distribution of use, as we discussed. Basis of accounting and restriction on distribution of use is there in 800. Report on legal and regulatory is there, and it is not there in 800, right? That's the basic difference. Few points to remember: always the scope guides the audit report. Title is basis of opinion para. In case of modified opinion, basis of qualified, disclaimer, as the case may be, adverse as the case may be. Note number as given in the final deliverables, please cross-check. Do not give cross-reference of wrong notes. Refer the client as the company, even in case of trust or any other kind of entity reports. This is not appropriate. Use the correct name, the entity, company, trust, something that's appropriate in the given case. Client stamps not there on the final set received, and firm stamp is not there on all the pages. These are inconsistencies that we generally see. Date and place of signing audit report is missing, which is not done. Company has their date and place of signing, but we have our date and place of signing. Incorrect use of term standalone consolidated in the reports. That's not done. If it's standalone, say standalone. If there is no console, then you can just say the company, but then don't intermingle like first page as standalone, second page as consolidated, and things like that. Section 197, managerial remuneration, IFC reporting is not applicable, yet it is reported. So that's something that you will have to take care of. So these are few of the observations from the QRB, FRRB booklets and personal experiences. Inconsistency of figures. Note number between financial statements, audit report, rounding of figures, not consistent. So let me give an example. Schedule 3 now has definitive, earlier it was may and now it is shall, and it says that if this turnover is this, then you have to round off to this. So say, for example, the entire financial statements is in lakhs. The notes also has to be in lakhs because that is part of the financial statements. Audit report, if you're giving a qualification, it has to be in lakhs only. Now, where is it written? That is not written, but it obviously makes sense if the entire financial statements is in lakhs or crores, then the audit report cannot be an absolute figure. It also has to be in lakhs of crores only. Digital signature, dates cannot mismatch. You have seen articles which say that, auditor signed a financial statement before the company when it was not appropriate. So you have to always, so the procedure is board actually approves the financial statements first, then you generate the UDIN. Don't generate it in the morning if the board report is going to happen in the evening. So generate it in the evening after the board meeting happens, and then affix the UDN and then do it. If you're doing it a later date, then ensure that you write the UDN appropriately. Guidance note on reporting under 143(3)(f) and H. Please take out time to read. Guidance note on CARO. Please read. Implementation guide on 11E, 11F. Implementation guide on 720, 700, 705, 706, 701. Guidance note on IFC. Consolidated financial statements, 11G, that is audit trail. And then significant audit matters, compilation by ICI also, and there was a latest compilation also. So these are all the reference material that will be, try to pull out all the reference material at one place so that it becomes handy that if you want to check something somewhere on the audit report, it's all available largely on one slide. So I think largely that's what I had to deliberate for the day. Happy to take up any questions, discussions, suggestions, or any thoughts actually. Do we have any questions, Chinky?
Yeah, ma'am. Thank you so very much, ma'am, for sharing your incredible expertise with us. Let's start with the question answer session, ma'am.
Yeah.
The very first question,
Your voice is breaking. I'm sorry. Your voice is
is
breaking.
engagement letter necessary even if we are doing audit of that client regularly from many years?
Your voice is breaking. Chinky, your voice is breaking. Hello?
Hello,
Yeah.
is it okay, ma'am?
Yeah. Now better.
Okay. My first question is engagement letter necessary even if we are doing audit of that client regularly from many years?
Yeah, if you are doing it, if you are entering into an engagement letter for more than 1 year, then please renew it. If you are doing it for 3 years, 4 years, it's possible. But then, you lose your, now this is a personal advice, I would say, you lose your scope for increasing the fees if you make the engagement letter very rigid. I would advise like at least it is better that you make it every year, and if not, then maximum for 2 to 3 years should be your engagement letter. Then you can revisit because there is so much of change in laws and regulation. You should always have your engagement letter alive. It should not be once upon a time I made it and I can use it all the time. So you should have it alive.
Okay. Ma'am, second question. If key audit matter is not applicable, then is it necessary to comment upon it?
No. If key audit matter is not applicable, now for us only listed companies have to have key audit matter. If there is no key audit matter in listed company, you have to write there is no key audit matter. But if it is not applicable, you need not write anything.
Okay. In some cases, client requests not to give any qualification, then what to do?
So audit report is your property. Audit is your independent auditor. You have to remember that. Client will never accept any qualification. But if you have done the work, if you have sufficient appropriate audit evidence to support your opinion, and you feel and you have the non-compliance in front of you, you have to qualify. So there was a question in another forum. They said that then the client will not come back to us next year. I said you have to go in search of another client some other time.
Right, very true, very true. Okay, next, ma'am. Can you please clarify on the backups by companies in case of non-compliance? What is the duty of auditor then?
Yeah, so as you see from August itself, August 2022 itself, this daily backup, earlier the clause was there. It used to say periodic backup. Now it is daily backup, right? Earlier also you could qualify the legal and regulatory matter if no backup was taken. But it was not so much in limelight because it is daily backup. It has gained so much of importance. Now, if no backup is being taken, then you have to put it in the legal and regulatory matter. However, if there are too many changes and you also cannot get any audit trail and you cannot actually see what is happening in the accounts, then it becomes a matter of true and fair view itself.
Right, ma'am. Right. Next question. When material uncertainty para is given, then no need to qualify the audit report.
So material
Is there
uncertainty,
any need?
as we discussed, material uncertainty, if conditions exist and if there is support available, then it becomes a milder para. If conditions exist, no support available, then it becomes a little bit more harsher. It may be a qualification. Okay, but then if conditions exist, no support available, and the situation is getting worse, I showed the example also that then it becomes an adverse report completely.
Right, ma'am. If company is not doing any business from last 3 to 4 years, how to report then an audit report?
That is a going concern issue. Going concern issue is not only if you have money. If you have money in the company, but you don't know what is to be done, and you don't have any plan, any project, anything, you still can have a going concern wherein the issue is the company doesn't know where to go, because if three people have are directors, and if the company has money, they can decide that I will take my amount and I'll go out on any day. So it is still a going concern issue. You should have a MUGC para there.
Uh-huh. If it's prepared on liquidation basis, then EOM. Emphasis
Yeah,
of matter.
I showed that over the screen. If it is liquidation basis, then the EOM says that everything is on liquidation basis. And also there is a slight tweaking in the management responsibility as well as the auditor's responsibility paras.
Okay, okay, I'll be asking you one more question. Shares of company A is held by holding company B, the 100% holding. During the year, company B transferred the entire shareholding to another company C,
Hmm.
which is a different group.
Hmm.
Should the auditor of company A report this in EOM of company A audit report?
No, it is deconsolidation. I had a subsidiary. I had a wholly owned subsidiary. Now it is transferred to another person. So it is deconsolidation. I'll deconsolidate, give the disclosures accordingly.
Okay.
And when I deconsolidate, then there is no consolidation report as such. So there will be a specific note and a complete disclosure that has to come in the standalone itself. And in the standalone, the investment is sold, right? So accordingly, effect has to be given. And if the investment is material, then it will call for an EOM.
Okay. Right now. True. Okay. The next one. Client is saying he will do the business in company, and in real, he's not doing anything from past 4 to 5 years. How to report then?
It's again a going concern. He is saying that I will do something, I'll do something, but you're seeing that nothing is being done. So might as well take precedence. So for example, for provision for doubtful debts, what do? You ask him to provide for if he is not receiving for more than 2 years. He is telling, ha, paisa aa jayega, but it doesn't come. So you know that money is not flowing in. Then you have to do something which is realistic. Then you go and qualify the accounts receivable, right? It has
Right.
not come from 4 years, but then the management is not done the provision. So similarly, he is sitting on it and he is saying, I'll do something, but nothing is done. It is a going concern issue, because he may close down any day and go out.
Right, ma'am. If sundry debtors and creditors are not confirmed, confirmation not yet received, then how to present this in audit report?
You can do alternate procedure. Alternate procedure can be rollback, roll forward procedures, checking the bills, invoices, existence from GST website, from PAN number, cross reference, and all that. If you're not able to get anything, then actually, if you're satisfied with the alternate procedure that the existence of the customer are there and it is not a dummy or fake customer, then you can document all this and then say you can live with it. If you're not satisfied, then it has to be a qualification.
Right. Okay. Next one, ma'am. Emphasis of matter should not be a key audit matter.
Yeah.
If in later turns out to be qualification, do we need to revise risk of material misstatement in line with the key audit matter?
Risk of material misstatement. So you are going into the file and you're going into the documentation. So risk of material misstatement as per your SA 315 is more that whatever you perceive as a potential risk at the beginning of the audit. So as you start conducting the audit, once you finish your planning, you can still come across some of the issues or some of the risks. So no one stops you from revising your planning. So if it is a risk of material misstatement, so if you are saying that it was an EOM which got converted into a qualification, uh, very rare case it happens, because a qualification gets converted into EOM many times because they do the adjustment, but the amount is significant, so we want to put an EOM. An EOM getting into qualification is rare, but if it happens and if it is like of such a magnitude that you initially thought EOM will do, but later on by looking at the entire picture, you thought that no, I have to do a qualification. then you don't have to go to the planning stage and again revise entire documentation. You can add a risk of material misstatement even at the closure stage. That is allowed by the standards of auditing.
Okay. In case of first year audit, what is standard para, ma'am?
Standard para that I actually displayed on the slide also, that we are appointed as the auditors in this year. Earlier, so and so was the auditor of the company, and he has issued a qualified, modified, clean opinion dated so and so. You can either reproduce the qualification or you can write it in brief. So that is given in the opening balance standard.
Where to report in case company made mistake in computation of CSR liability and spending of it?
If it is again material, it may go into qualification because it is one of the essential sections of the Companies Act. If it is something that is a non-compliance but not very material, then last item after all the items that is required under 143.3, the last item you can make one line item and you can write it there that the company has not complied with CSR. And also it is there in the additional reporting, right? Caro.
Right. If inventory valuation of inventory is done by company without maintaining
Without maintaining?
detailed recording such a case,
Okay.
does the auditor requires to give qualified opinion or modified opinion?
So if inventory is again inventory, I assume it to be material area. If they don't have quantitative details, I don't know how did they do the valuation. So if I have 5 types of inventory, for example, if I say bulbs and tubes, I have 5 types of bulbs. So I should know category 1, 10 items, category 2, so and so. If I don't have quantitative assessment, then I can't have qualitative assessment. How can I do valuation? So obviously the valuation that is done is not proper. So it becomes a matter of qualification, in my view.
Okay. If a company has 3 immovable property but has revalued only one, whether any qualification to be made?
This is not something that I can answer here. Why did they revalue? How did they revalue? Did they use the registered valuer? Is it, I don't know whether it is a government granted property or otherwise. There are multiple questions you will have to answer before you answer the questions. And why they did not revalue 2 other items is another question. Unless we get an answer to it, I don't know why we should qualify.
Right. I think with this, I'm ending with the question answer session. Enough of
Okay.
questions. Yeah.
Great.
Thank you so very much for answering these questions very precisely and efficiently. They'll be working for us in future, definitely. Yeah, ma'am.
Thank you so much.
Thank you so much, ma'am. Your contribution was invaluable. I appreciate your professionalism. It was a pleasure having you with us today.
Thank you so
And I
much.
want to express
Thank you, ma'am. Thank you, ma'am.
sincerest gratitude for your participation as a speaker.
Thank you so
Thank you
much.
so much, ma'am. Thank you so much, ma'am. Before we formally wind up, I have received one more question. If you allow, can I raise that question, madam?
Sure.
Ma'am, regarding the back, if we are talking about the backups, then books are properly maintained, but only backup not be done daily. So why that is become proper books not maintained from statutory auditors perspective?
Okay, because that requirement of books of account is under section 129, and one of the requirement under 129 is daily backup. So when we are opining on that section, then obviously we have to read the whole section. We can't read part of the section because so earlier, if you remember, when it was shifting from hard copy to soft copy, they said that if I have everything in hard copy, then why do I comment on soft copy? And then partial hard copy, partial soft copy. This is like similar thing I can relate to. So you have to read the entire section, and this amendment is inside 129. So when I am commenting on 129, I have to take everything. If that is not done, that is part of not maintaining books of account. And one of the things is that, if I have to say why this is not available, it has to be appropriately available, because if you do some changes in the books of account and if I don't have a backup, I can't check anything and I don't have a trail, then that itself fails the very purpose of this entire audit per se, of any audit, I would say.
Last question, if there is a change in the accounting policy, so where is to be reported in this audit report if there is a change in the accounting policy?
Change in the accounting policy does not form directly part of the audit report. So earlier there was a time then when there is a change in accounting policy, EOM used to be given. But I don't think so it is necessary unless it is so material that you have, you are recognizing something on the basis of some criteria and then it has completely changed and there is an impact, then it will become an EOM. Otherwise, I don't see that it has to be somewhere in the report.
Fine, fine. Thank you so much, ma'am. Now we come to an end. It was wonderful deliberation, and you have covered everything regarding 700 series. And because this month is very relevant for all of us, because audit season is there, and everyone is doing the audit and finalization of audit. So I hope our members have benefited a lot with your deliberation, as you have covered all the aspects of mostly all these standards of 700 series. So on behalf of Auditing and Assurance Standard Board, I extend my heartiest thanks towards you, ma'am, for sparing your valuable time and enlighten all of us on various intricacies of almost all the standards of 700 series regarding the audit reporting and audit finalization. I also thanks to the Honorable Chairperson of Patiala Branch, Madam Chinky Verma ji, for sparing her valuable time and moderating and co-hosting this webinar jointly with the Auditing and Assurance Standard Board. Thank you so much, ma'am, for sparing your valuable time and moderating this webinar. On behalf of WSB, I extend heartiest thanks towards you, ma'am, also. I also extend our sincere thanks to all the participants of today's webinar. Thank you so much, ma'am. Thank you so much on behalf of WSB of ICA. Thank you. Namaste.
Thank you, sir. Thank you, Chinky ji, and
Thank you.
thanks to all the
Thank you.
participants for
Thank
patient
you.
listening. Thank you.
Thank you. Thank you, ma'am. Thank you.
Thank you, everyone. Thank you.